Everyone knows the story of Michael Saylor and now Tom Lee, who've accumulated billions of dollars in Bitcoin and Ethereum through digital asset treasury companies.
But what if I told you?
A new, more aggressive chapter is being written right now. A silent invasion where corporate treasuries are moving beyond Bitcoin and Ethereum and accumulating massive positions in altcoins like Solana, SUI, and even Worldcoin. This isn't about diversification. It's a high-stakes gamble that could either trigger the next parabolic altcoin run or introduce a level of systemic risk that makes the last cycle look tame. By the end of this video, you'll know all about who's buying what and what it means for your portfolio. My name is Nick, and you're watching The Coin Bureau. First up though, nothing in this video is financial advice. It's purely educational content intended to inform you about the growing trend of corporate altcoin treasuries. And if you want to get more content like this, then smash that like button, subscribe to the channel, and ping that notification bell. Now, let's get into it. Let's start with the darling of the last cycle, Solana. While Bitcoin treasuries are a passive store of value play, Solana offers something far more attractive. Yield. And that has attracted a new breed of corporate raiders. The game changer here is Forward Industries, a NASDAQ-listed company that recently acquired 6.8 million SOL for approximately $1.58 billion. And this move was funded by a record $1.65 billion private placement led by heavyweights like Galaxy Digital and Jump Crypto. But they aren't just holding, they've staked all of it, aiming to, quote, increase SOL per share at a faster rate than simply being a passive holder. And then you have Upexi Inc. Their Solana treasury is now worth over $447 million, and they generate roughly $105,000 in daily revenue from staking rewards. And they're not alone. Pioneers like DeFi Development Corp and Sol Strategies have also amassed significant positions, bringing the total held by publicly traded Solana treasury companies to over $1.46 billion. So, why Solana? Well, as of September 2025, SOL stakers are averaging around an 8% annual yield, and this allows these companies to create a self-sustaining treasury model. They can issue preferred shares and use the staking yields to cover the dividend costs without ever selling any principal. It's a compounding flywheel effect that Bitcoin treasuries simply cannot replicate. And this makes SOL an active strategic asset, not just a passive one. Okay, next up we have SUI, and the story here is less about raw yield and more about strategic top-down partnerships. The flagship player is SUI Group Holdings, formerly Mill City Ventures. This company, formerly a small venture firm, executed a massive $450 million private placement in July 2025. They used 98% of it to purchase 101.8 million SUI coins, instantly becoming the largest institutional holder. This wasn't just a market purchase. The SUI Foundation itself participated in the investment round, giving SUI Group an official relationship and unprecedented backing. And this gives them access to institutional-grade deal flow and a discounted token supply. Other firms like DeFi Technologies have also taken notice, making SUI their second largest digital asset holding after Bitcoin. And they're not just holding either, they're actively monetizing it through, of course, staking yields and their Valor SUI ETP, creating a dual revenue stream. And the rationale for SUI is clear. It's a bet on a high-performance layer 1 with deep institutional ties and the direct support of its own foundation. With a US-based ETF filing from 21 shares under review by the SEC, corporate treasuries are positioning themselves for a potential new wave of regulated capital inflows. And this brings me to our final and perhaps most controversial contender, Worldcoin. And this isn't a bet on DeFi or yield, this is a pure play bet on the future of AI and digital identity. The story here revolves around a tiny NASDAQ company called Altcoin Holdings. In September 2025, its stock soared over 3,000% in a single day after it was announced that Dan Ives, Wedbush's famous head of technology research, was taken over as its chairman. And his first move was to announce a $250 million private placement with a singular goal: to make Worldcoin the company's primary treasury reserve asset. The list of backers is a who's who of institutional crypto: Pantera, Kraken, Brevin Howard, and even the Worldcoin Foundation itself. In Ive's own words, he views Worldcoin as, quote, the de facto standard for authentication and identification in the future world of AI. And this is a fundamentally different thesis. It's not about on-chain activity or staking rewards. It's a conviction that as AI becomes more pervasive, proof of humanity will become an essential and therefore incredibly valuable piece of digital infrastructure. Now, if you want to make the most of what's coming, then you absolutely have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges around. To get these goodies, all you need to do is to hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click on the Sign Up Now buttons. Now, these deals will not be around for long, and they are only for Coin Bureau viewers, so take advantage of them ASAP, again, using the link in the description or scanning the QR code. Okay, so we have billions of institutional dollars flowing into these three distinct altcoins. The big question is, will this rally impact their price long term? Well, let's break down the pros and cons. The bull case is built on what we can call the strategy effect. Since 2020, strategy stock has surged nearly 2,900%, far outpacing Bitcoin itself. The playbook is simple: raise capital, buy crypto, and repeat. And this creates a powerful supply shock. In late 2025, institutions were absorbing over 3,000 BTC a day, while only 450 BTC were being mined. And that's a 6-to-1 demand-supply imbalance. This institutional buying provides massive validation for an asset, reducing its perceived risks and attracting more conservative capital off the sidelines. A 2025 report from Animoca Brands even found that stocks of firms announcing a crypto treasury pivot jump 150% on average within 24 hours. It's a powerful narrative. And this brings me to the bear case, and there are some serious red flags here. The first major risk is dilution. Many of these companies raise funds via private investments in public equity or PIPE deals. And this gives institutional investors shares at a discount, which can later be sold on the open market. And if history is any guide, these can be brutal for retail investors. Just look at the cautionary tales of Upexi and SharpLink. Both raised massive sums of money for their crypto treasuries, and both saw their shares plummet by over 60% once the PIPE shares hit the market. It's a tidal wave of selling pressure that many investors don't quite see coming. The second and arguably bigger concern is systemic risk, which industry veterans have been sounding the alarm about. Nick Carter of Castle Island Ventures compared this trend to the old GBTC premium trade, which blew up spectacularly and triggered the collapse of firms like Three Arrows Capital and Celsius. His point is that when hundreds of firms are all making the same one-directional bet, the entire structure becomes fragile. Galaxy Digital warned that a downturn in crypto prices or investor sentiment could cause the whole thing to unravel, putting massive downward pressure on the very assets these companies hold. Finally, there's the risk of market saturation and regulatory headwinds. Since January 2025, over 180 public companies have announced crypto purchases worth a collective $132 billion. And this trade is getting crowded, and regulators are noticing. In 2025, Nasdaq implemented new rules requiring shareholder approval for equity issuance tied to crypto purchases, adding a significant layer of friction to this playbook. The easy money phase of this strategy might already be over. So, to wrap things up, the institutional invasion of altcoin treasuries is a double-edged sword. On the one hand, it represents the most significant validation these ecosystems could ask for. It's Wall Street capital recognizing the unique value proposition of yield-bearing assets like Solana, foundation-backed ecosystems like SUI, and moonshot bets on AI infrastructure like Worldcoin. And this creates real demand and a powerful supply shock that could drive prices of these respective cryptos higher. But, on the other hand, it introduces a new layer of complex financial risk. The strategies being used, particularly the reliance on dilutive pipes and leveraged balance sheets, are creating a fragile system that could amplify the next market crash. This isn't the simple digital gold narrative of Bitcoin. It's Wall Street bringing all of its financial engineering, both the good and the bad, into the altcoin market. The line between corporate finance and crypto protocols is blurring faster than ever before, and we are all part of that experiment. Now, if you appreciate that, then smash that like button, subscribe to the channel, and ping the notification bell so you don't miss our next video. Until then, be sure to check out our video about how Tom Lee turned around ETH with his digital asset treasury play. That's right over here. Thank you guys very much for watching, and I'll see you again in the next video. This is Nick, over and out.